today what I'd like to do is try to quickly point out what you need to know in retirement planning and what you need to do about it. Because when it comes to retirement planning, a lot of people just think that, oh, all I have to do is put away more money in my 401k or my retirement plans. That's not the case. So let's talk about what you need to know. First of all, there's many considerations when you look at your retirement planning. And when you look at all of them, there's 7 going around the retirement income stream here, but only one of them has to do with actually investments. So let's touch a little bit on the longevity issue. It's very important nowadays because people are living longer. They're living longer because of medicine, the advancement of medicine, their diets, and technology. And when you take a look at this chart here, if you are a 65-year-old, and let's just say you're a married couple, there is a 50% chance that one of you will live past the age of 90. And there's a 50% chance that both of you will live past the age, I think it says 88 up there. So people are living longer. I had a client in our office a few weeks back, and we were putting together the retirement plan or a financial plan for him. And I asked the question, how long do you expect yourself to live? And he came back and he says, well, my wife, I would think she's going to live till 80, and I'm going to live till age 70. And I said, are you okay? Are you sick? And he said, no, I just don't expect myself to live past age 70. That's the normal, isn't it? Well, it's not. And so we went through a long discussion, and I kind of worked on him, and he finally realized that, you know what, I can't plan my assets to only be there for me only till age 70. So longevity is a very important thing. You have to plan for a longer retirement than you probably expect. Let's touch on inflation. Inflation erodes your purchasing power. And this chart easily shows that if you have a 3% inflation rate, if you had $100,000 today, in 10 years from now or 15 years from now, it's almost cut in half at 54,000, I believe. So you need to be aware of not only the regular inflation rate, but when you plan for your investments, when we model out a portfolio, we model it out for a certain percentage above the inflation rate. That's what our target returns are. It's not returning, the return doesn't start at 0. The returns of our expectations start above the inflation rate. And that's very important to know, because once inflation increases, we also expect our market or our returns to increase as well. When it comes to investments, you have to be realistic about withdrawing your investments. And if you plan to withdraw for a long period of time, you must examine the various investment rates. And what Jeff brought up earlier today in terms of what happened in 73 and 74, we put this chart together. If you invested or if you had $500,000 at the beginning of 73, and you set up systematic withdrawals of anywhere from 5% to 9%, that's how long of a time frame you have for that $500,000 to work for you. So if you took out a 9% withdrawal rate from your investments in 1973, it barely gets to 1982 to 1983. Versus if you had a 5% withdrawal rate, that lasted you over 20 years. So it goes back to having the importance of understanding what your investment rate's at, where the current market is going, and during that time, is it okay for me to pull back a little bit and take less withdrawals and get a better understanding of, okay, I know I have to save more money now, but maybe in the next couple of years, if the markets are doing better, I can pull out a little more then. Jay touched on a little bit about investments and the range of investment performances. So let's take a look at building your portfolio. The single most important thing to understand, and what Jay and Tony both discussed, is risk tolerance. Understanding what you need to do for your investments, number one, to get you to retire, but number two, and most importantly, what can I do? How much aggressive risk can I take and still be able to sleep at night? And what this chart shows you, it shows how much percentage of it you have in the S&P 500 or equities, as Tony was mentioning before, whether you have 0% or 100% all the way to the right, versus the amount of fixed income. So let's take, for example, if you have 50% equity, 50% fixed income, from 1926 on through 2008, at the high year, you had a 35% return, and the low year, you had a negative 24%, averaging out during that time frame of 8.3%. Now, when I speak with clients about this particular slide, do I talk about the top number or do I talk about the bottom number? We usually discuss the bottom number and the average, because let's face it, we love the top numbers and we love to talk about the top numbers, but that's really not as important as if I can stomach that bottom range. And once we know what type of risk tolerance, and once we have our portfolio together, is that all we do? Are we done? And now we invest our portfolio and we never look at it again, right? Kind of like the hold that we were talking about, the long-term holds. You do want to have long-term holdings, and we do invest for our clients. We expect to hold our portfolios, our investments in our portfolio long-term. But at the same time, we also have to look at what's happening in the portfolio. So this is an analysis from 1986 through 2006. If you started with a 50-50 allocation, just like we looked at on the last slide, take that allocation and we held it and made no changes for 20 years. If you look, the stock position all of a sudden is at about 72, 73%. And the fixed income portfolio is at about 27. Understanding your risk tolerance, you're thinking, well, I shouldn't be near that 50%. What's very important to do, that you need to rebalance your portfolio periodically. Now, what's periodically? For some people, it may be 12 months. For some people, it might be 18 months, maybe 24. But I would never go farther than that. And what I'm not saying is that if your portfolio goes from 50-50 to 60-40, do you bring that all the way back down to 50%? No. But it's very important that you work back towards your target. That'll make you more comfortable with your risk tolerance. Let's take a look at this. If we say instead of the blue being equities, what if that's fixed income? So let's say if that portfolio went out in 2008 and 2009. Your equity would most likely look like to be the orange and your fixed income the blue, right? Well, what's also important when you rebalance, it's not when you're doing well, but it's also when you're not doing so well. Different asset classes will have different returns, and you always have to bring that closer to your risk tolerance range, whether the market's been good to you or not so good. So it's important to rebalance your portfolio as you go through your investing. Now, once you have your investments and once you understand your risk tolerance, where am I going to put that portfolio? Where am I going to put these assets? Well, when we invest with our clients, we look at a few different buckets, as I mentioned before. For IRA accounts or 401ks, we like to put the investments that have ordinary income, such as bonds, money markets, real estate holdings. In the taxable accounts, which could be your standard brokerage accounts or your trust accounts, we like to put stock positions in there, the equity positions, because you can control somewhat your capital gains, number one. Number two, capital gains, their rate is much lower, 15% this year, 20% I believe next year. I think John may touch on that in a little bit, but it's still lower than probably what your ordinary income is. So we tend to keep those investments in your brokerage accounts. And finally, for your most aggressive types of stock investments, whether it be international or maybe small cap, we like to put them in the tax-free accounts or what has been, coming that's new for about 10 or 13 years or so are the Roth accounts, where you invest in those monies, you pay no taxes when you take the money out. Why do you put the aggressive ones in there? Well, yes, you are taking more risk, but you're hoping that you'll also have a greater reward. And if you have that greater reward, you don't want to pay taxes on it. So that's where we like to keep those types of investments. Just a few other things about what you need to know in retirement planning. Obviously, some Social Security basics. You can start taking Social Security out at 62. There is a full retirement age. For us here in the room today, most of the ages are either 65 or 66, depending on how old you are right now. And if you don't take out your Social Security or don't apply for the benefits, and if you wait, the longer you wait up until age 70, the better benefit you'll receive from Social Security. However, it could also work against you. So let's say if you want to take an early retirement or you take Social Security out at age 63 and your full retirement benefit age is 65 or 66. If you have earned income over the $14,160, for every $2 you earn over that amount, Social Security will take away $1 of your benefit. So for example, if you had earned income of $50,000, we'll subtract the $14,000, let's just say $14,000, you end up with $36,000 over their income limit. You divide that out by 2, that equates to $18,000. So the first $18,000 of Social Security benefits you would receive would be taken away from Social Security. So it's very important that if you are still planning on working and still making somewhat of an income, that you may not want to take your Social Security benefits immediately. Once you reach full retirement age, doesn't matter how much you make, you can take out whatever you want or earn as much as you want, and you will receive every dollar of your benefit. And finally, Social Security can be taxed up to 85%. Let's touch on health insurance. I think this is one of the most critical issues going forward, not only because of what's going on in the government right now, but the inflation factor that health insurance has. And it's currently, like I mentioned before, about 7%. Once you retire, you have a few different options if you're under age 65. You can sign up for the COBRA policy of your previous employer's plan. That can last you 18 months. You can take a part-time job out, and if they have an insurance plan and they offer it to you, you could potentially receive a plan from there. You could also buy individual insurance on the open market. What they'll look for is your insurability and the cost. And if you have pre-existing conditions, well, depending on what the healthcare bills will be passing, that could also change, but the price that you may have to pay might be quite up there, pretty high. You can also consider a high deductible health plan. If you're pretty healthy and don't need that much insurance, consider a high deductible plan. And if you can't find adequate insurance, you can always go to the Wisconsin Health Insurance plan. Now, once you hit the age 65, obviously you can apply or register for Medicare. And there's many different parts to Medicare. You got the hospital, you got the outpatient, you have the drugs. The one important one is the Medigap policies. There's quite a few Medigap policies out there that you might be looking at. And if you go to medicare.gov, they have the Medicare policies or the Medigap policies out there, and they actually break them down for you. It's a pretty nice site.